Welcome to Talk Tickers, where we cut through the jargon of earnings calls and get straight to what matters. Today we're doing a deep dive into Silicon Motion Technology Corporation, that's SIMO. They just had their Q2 2025 earnings out. Results dropped July 30th, calls the 31st. We're talking semiconductors here, specifically storage controllers. And there's a pretty interesting story unfolding.
Oh, definitely interesting. I mean, how the market reacted or maybe didn't react to a clear beat from SIMO.
Yeah.
It tells us a lot, not just about them, but the whole semiconductor and storage scene right now. There's kind of a paradox here we need to unpack.
A paradox, yeah, good word for it. Let's hit those headline numbers first, because like you said, on paper, they looked undeniably strong. Okay, so non-GAAP EPS, $0.69 per ADS. That smashed consensus, which was hovering around, what, 52 to 54 cents?
Right, a significant beat there.
And revenue, too, $198.7 million. Again, well above the roughly $180 million the street expected. That's up 19% quarter over quarter.
Though still down a bit year over year, about 5.7%. Important context.
True. Good point.
Yeah.
And they had solid non-GAAP gross margin, 47.7%, operating margin at 12.8%.
Yeah.
So yeah, looks good on the surface.
It does, and that's where the paradox kicks in, right? You've got these clear beats, but the stock, well, it popped a bit at the open on the 31st, but then kind of fizzled, ended the day flat to slightly down. So what does that tell you? Maybe the market already baked some of this in, or maybe they're seeing something else under the hood.
Cautious optimism, perhaps.
Exactly. Cautious optimism. They're looking beyond just the headlines. And we should probably mention the cash position, too. $282.3 million in cash and equivalents. But, and this is maybe part of that caution, they did have an operating cash outflow in Q2, about $17.3 million, plus $15.6 million in CapEx. That outflow is definitely something to keep an eye on.
Yeah, definitely need to circle back to that cash outflow. Okay, so despite the market's, let's say, muted reaction, what was management's story? What were they emphasizing? Well, they were pretty clear. They beat their own guidance on revenue and operating margin, and they put it down to new products hitting the market, gaining market share, and pushing into new areas.
Standard playbook, but seems like it worked this quarter.
Right. And looking ahead, they're projecting, and I quote, strong revenue growth and profitability improvements for the second half of the year. They're banking on high-end UFS controllers, PCIe stuff, Automotive definitely, and their Monatan platform.
And that big target?
Ah, yes, the big one. Exiting 2025 with a $1 billion revenue run rate. That's ambitious.
Very ambitious. Requires some serious execution in the back half.
Okay, let's shift gears a bit. What about the broader market, the NAND flash market? What did management see there?
They said things improved in Q2. Flash prices started ticking up as PC and smartphone inventories came down. Demand seemed, well, modestly better.
And enterprise, AI's impact.
Still strong. Enterprise storage demand robust, thanks largely to AI needing more and more data faster.
Right, that makes sense. And the NAND makers themselves. They're being disciplined, cutting back on capital spending for adding capacity, but pushing prices up, trying to balance supply with that enterprise and AI demand.
Which means
SIMO's partners, the module makers, they're actually building inventory now. They're expecting NAND prices to keep climbing in the second half.
Stocking up before it gets more expensive. Smart.
Exactly. And here's a key point they hammered home. QLC NAND. That's quad level cell. Packing more data per cell, making storage cheaper, denser. Demand for QLC is growing everywhere. Client, smartphone, enterprise.
And SIMO's position.
Unique. They stress they're the only controller company partnered with all the flash makers. That's a big deal, especially with QLC becoming so important.
It's more than a big deal. It's a huge structural advantage. Think about it. Partnering with everyone, especially on QLC, it means they're right at the center of this industry's shift to cheaper, denser storage. They get visibility no one else has. And that experience managing QLC, combined with those partnerships, that's why they can claim industry leadership. It's about sustainable growth, potentially for years.
That positioning sounds powerful. Let's see how it plays out in the specific business segments. Where are they seeing the traction? Let's start with mobile eMMC and UFS. Apparently that segment did better than expected in Q2. They've got strong bookings heading into the second half from both flash makers and module makers.
Any specific trends there?
Yeah, they mentioned a move towards discrete solutions, separate eMMC UFS chips, partly because low-cost mobile DRAM is available, and the flash makers are outsourcing more controller design to stay competitive.
Makes sense. And new products.
Definitely. Accelerated demand for their new high-end UFS controllers, especially for mainstream and high-end phones. They're getting into new phone OEMs using QLC UFS too.
It's not just phones. eMMC is growing in IoT devices, smartwatches, TVs, set-top boxes, even those new AI glasses people are talking about.
Now, that non-smartphone market is big.
Over 800 million units a year, they said. So yeah, significant. Their goal, 30% mobile market share within 2 years.
Okay, ambitious, but clearly a growth area. What about SSDs? The PC market. PC market seems to have hit bottom in Q1, stabilized in Q2. They're expecting low single-digit growth for the full year, but a stronger second half. Usual stuff, back to school, holidays, plus the Windows 10 end-of-life deadline in October pushing some upgrades.
And the AI effect.
Big driver here too. AI at the edge, meaning AI processing happening directly on PCs, is pushing demand for faster SSDs. That means more demand for their PCIe controllers. They expect significant market share gains in client SSDs, especially high-end PCIe Gen 5.
How's that Gen 5 ramp going?
Pretty well, it seems. Their 8-channel PCIe 5 controller, launched last December, grew over 75% just from Q1 to Q2. It's already more than 10% of their client SSD controller revenue.
Impressive ramp.
And they've got 4-channel PCIe controllers starting to ramp later this year. The big goal there, 40% of the entire SSD market by 2028, up from about 30% now.
Okay, aggressive targets across the board. What about automotive? That always sounds like a promising area.
Yeah, they highlighted tremendous design win activity there. Cars are getting more storage, needing faster, lower latency solutions.
Yeah, safe.
Crucial point. They were the first, they claim, to get ASIL-D Level 3 certification for PCIe 4. That's a top functional safety standard, really important for things like driver assistance systems. Shows they're serious about reliability.
And future tech.
They're taping out an automotive PCIe 5 controller in 2026, already shipping current stuff to big names. Yeah. Mercedes, Tesla, BYD, Xiaomi, Toyota, Honda. Wow, that list. Mercedes, Tesla, BYD, Xiaomi. That's quite the roster. Really covers a lot of ground, especially with strong demand coming out of China.
So they must be feeling good about that segment.
Very confident. They think automotive will be at least 10% of total revenue by 2026 or 2027.
Okay, that's significant.
Oh, and a little side note, their memory card business got a nice boost from the Nintendo Switch 2 launch. Doubled revenue year over year in the first half.
Ah, okay, didn't see that one coming. So mobile, SSDs, auto, what's left? Enterprise. Monotone.
Right, the Monotone platform. AI is the story here too, obviously.
Yeah.
Data centers need faster access, pushing SSD adoption.
And Monotone fits where?
It's designed for managing those high-density, high-performance SSDs, especially for what they call the warm storage market. Think pairing it with QLC to replace old spinning hard drives. Cheaper, faster.
Makes sense. Any other angles?
Yeah, they're seeing interest in using Monotone for compute storage too, with TLC-based drives, getting up to 16 terabytes.
And longer term?
They're working on a new industry standard, JGDIC standard, for nearline flash. That's maybe 3-5 years out, but the goal is to push QLC even deeper into warm storage.
So positioning for the future there too.
Exactly. And they mentioned a demo coming up next week at the FMS conference with vast data, showing Monotone working with NVIDIA's Bluefield 3 GPU platform using a DPU, a data processing unit specifically for AI storage, highlighting how it helps manage that huge AI data growth.
Okay, that NVIDIA Bluefield demo sounds important. It really ties together their strategy across all these markets, mobile, client, auto, and now high-end enterprise AI. It justifies the R&D spend, the go-to-market push, and that NVIDIA Bluefield DPU program itself, getting final qualification, production in Q4, that is a major win. Could really open up the data center market for them.
So the roadmap looks solid.
Very solid. They've got the 16-channel PCIe 5 Monotone now. A 6 to 8-channel version, the 8388, is coming by year-end for those massive 64 128 terabyte enterprise drives. And they're not stopping there. PCIe Gen 6 Monotone on TSMC's 4-nanometer process, taping out next year. They're investing way ahead.
Okay, brings us back to the financials, though. That cash outflow you mentioned earlier.
Right, so cash went down, partly due to a $16.7 million dividend payment, which is shareholder return, but also, crucially, they deliberately increased inventory.
To support the expected ramp-up.
Exactly, to support what they expect to be a strong second half. And operating expenses were up, yes. Higher R&D, more sales and marketing investment for these new products. And interestingly, the stronger Taiwan dollar actually hit them. Management said it impacted the Q2 operating margin by about 1 percentage point.
So maybe not entirely structural cost increases, some effects headwind too.
Seems like it. And despite that, they're sticking to their guns, projecting a return to 25% plus operating margins in the medium term. That relies on these new products scaling up, driving revenue, and improving growth margins. They're targeting 48-50% gross margin by year end.
So they're expecting significant operating leverage to kick in.
That's the plan. The investments now are meant to pay off big time down the line.
Okay, my head's kind of spinning with all these details.
Yeah.
Let's pause for a sec. What's the single most maybe surprising thing for you out of all this, especially thinking about how the market just sort of shrugged?
Good question. If I had to pick one, it's probably the sheer breadth and depth of those design wins they talked about. Especially in automotive, getting names like Tesla and Mercedes and BYD, and also how fast that PCIe 5 stuff seems to be ramping in SSDs. It suggests their competitive position, maybe particularly with that QLC expertise, might be stronger and wider than the market's giving them credit for right now.
That's a really key insight. Okay, so here's where it gets really interesting for you, the investor listening in. Despite that flat reaction on earnings day, look at the track record recently. SEMO stock is up nearly 10% over the last month, almost 25% over 3 months, and a very impressive 43% over the past year.
Yeah, significantly beating the SOXX semiconductor index.
Exactly. And analysts noticed the Q2 results. Craig-Hallum boosted their price target to $100, Susquehanna went to $90. And the backdrop, generally, the semiconductor market is strong, maybe a bit mixed depending on the segment, but themes like AI PCs and storage demand look set to drive controller sales into the second half.
Which really deepens that puzzle, doesn't it? This raises an important question. Given such strong performance leading up to the report, a positive outlook from management, solid analyst bumps, why did that initial pop on earnings day just fade away? And what does that signal for you, the investor?
Right, what gives?
Well, like we touched on, maybe some profit taking after the run-up, maybe that Q2 cash outflow spooked some people,
Right.
Or maybe the year-over-year comparisons, though improving, still aren't stellar across the board. Or honestly, maybe the bar for any semiconductor company right now is just incredibly high. You have to absolutely blow expectations out of the water to get a sustained rally.
So is the market maybe just not buying that $1 billion run rate target yet? Or worried the spending required to get there, that OPEX and cash burn is maybe a bigger drag than management is letting on?
Could be. Those are valid points for bears to consider. Looking ahead, what could make the stock outperform? Key catalysts, I think, are confirmation of those PCIe 5 share gains when Q3 results come out. More automotive qualifications hitting. We know those take time, but they're in the works. How inventory and wafer costs play out with their NAND partners, that's huge. And just the macro picture, how strong is demand really for AI PCs and new phones in the second half?
And the risks?
The flip side.
Well, if they stumble, misses on execution with those embedded or SSD solutions, if OEM orders come in weaker than expected, that could hit the stock hard, especially after the run it's had. The multiple could compress quickly.
But management's own guidance for Q3 still points up.
It does. Revenue projected between $219 and $228 million. Gross margin improving to 48-49%. Operating margin ticking up slightly to 12.3-14.3%. So they are guiding for continued sequential improvement, even if the market paused for breath. Okay, let's shift gears completely now. It's time for our not financial advice segment. Remember, this is purely for discussion, sparking ideas, maybe a little entertainment. Definitely do your own research before acting on anything you hear.
All right, let's have some fun with this. So look, despite that profit taking, despite the market's, let's call it lukewarm reception to a pretty strong quarter, my conviction, or let's say my thesis here, is that Silicon Motion might be in the early innings of a multi-year re-rating. Why? Because I think the market isn't fully appreciating the impact of these pivots into higher growth, higher margin areas. The spending now, that cash burn, it's masking what could be some serious operating leverage down the road.
Okay, intriguing thesis. So what's the outrageous but plausible idea?
Consider a long position, but using options to get leverage and define risk. Specifically, a long-dated, slightly out-of-the-money call option, maybe something like the June 2026 $90 strike call.
June 2026 $90 strike.
Yeah.
Okay, why that structure and why now?
Right, the rationale. First, I think those growth engines are underestimated. The speed and profitability of automotive wins getting to 10% plus revenue by 2026 or 27, that's huge. The PCIe 5 share gains in SSDs hitting 40% market share by 2028, also massive. And Monatan, especially with that NVIDIA Bluefield DPU win going into production soon for AI storage, game changer potential. Second, The operating leverage. Yes, OPEX is high now for R&D for market entry, but management sounds confident about getting back to 25% plus operating margins midterm. As revenue scales from these new higher margin products, remember that 48-50% gross margin target by year-end profits could really accelerate that Q2 Taiwan dollar hit, likely temporary. And third, that niche leadership. Being the controller supplier to all the flash makers, especially in QLC, that's a structural moat few others have.
So the outrageous but plausible part.
It's using the market's current hesitation, that may be slightly cautious sentiment, as an entry point. You're betting that over the next year and a half, these long-term drivers will become undeniable. That execution will continue, forcing the market to reevaluate SIMO not just as a component supplier, but as a strategic player in key growth trends like AI and automotive. The longer-dated call gives these catalysts time to fully play out, pushing the stock potentially well past current analyst targets. It's a bet on execution, yes, but also on the market eventually catching up to SIMO's transformation story.
Wow, okay. A bold call, leveraging that potential disconnect between short-term sentiment and long-term drivers. And again, folks, definitely not financial advice, just a thought-provoking scenario to consider. Really interesting take. All right, let's quickly wrap up our deep dive into Silicon Motion's Q2 2025 earnings. Key takeaway. They delivered a strong beat on the numbers, driven by new products finally ramping up, clear market share gains in mobile and SSDs, and really significant progress in those big future growth areas, automotive and enterprise AI storage.
Yeah, and so what does this all mean for you? It means that even though the stock market gave a bit of a mixed signal right after the call, the underlying story for management is one of charting a clear path forward. They seem to have a strong product pipeline, good strategic positioning for the second half of this year and beyond. But, the proof is in the pudding. The next few orders are really crucial to see if they can execute on this ambitious strategy and validate these growth targets.
Precisely. Execution is key from here. Well, thank you for tuning in to Talk Tickers for this deep dive. We really appreciate you joining us as we try to make sense of the earnings landscape. If there's a company or an earnings report you want us to tackle next time, let us know. You can find ways to connect with us wherever you get your podcasts or on our website. Until then, keep digging into those numbers.